Hello guys, in today's video let's talk about monetary policy and fiscal policy as two main types of economic policies in macroeconomics. First of all, as a rule, these two types of policies are usually talked about in the context of how to shift the aggregate demand curve upwards to the right and so to stimulate the economy, the real GDP, and the economic growth. Basically, it refers to the government functions here, and it's one of the main basic common questions in macroeconomics. First of all, we should take into account that monetary policy is in some way an indirect policy. It affects the economy indirectly, while the fiscal policy is a direct one. Monetary policy is about printing money and deciding how much money we should print in order to stimulate the economy. It's usually done by a central bank of a country. Which has been given the right to print money and to maintain its stability, the stability of a national currency here. Printing money doesn't mean buying goods and services directly in the real economy, in the market, by a central bank itself. No, the main goal here as a central bank is printing and lending this money to other economic financial institutions, corporations, banks, and so on. After borrowing the money, these economic subjects spend this money in the real economy and increasing the investment, the spending here, and thus shifting aggregate demand curve upwards to the right. It's what we need here. So let's look more closely at the money market model here. On the horizontal axis we have the amount of money in the economy affordable to borrow, for example, billions of dollars, and on a vertical basis we have the cost, the price of money, interest rate, percent. For example, here we have the point of equilibrium number 1 and the equilibrium price of money here 8%. It means that if investors in this country get more than 8% return on their investment, they will borrow money at 8% because it's profitable for them. But after making operations in the money market by a central bank, after lending money, central bank will shift downwards to the right the supply curve here by increasing the affordable money to be borrowed in the money market. For example, now it's $60 billion. Can we now borrow the money at the same 8% interest rate as it was in the previous period of time before shifting the curve? The answer is no, because we don't have this option here. The demand curve here doesn't work like that, because here we have an assumption that all other things equal. It means that the demand curve here, demand doesn't change, it remains the same. So here we have the new point of equilibrium number 2, and we have the new price of money, equilibrium price of money, and now it's 5%, $60 billion and 5%. And now investors who get more than 5% return on the investment in this country, they will borrow money at 5%. Unlike the investors like in the previous period of time before shifting the curve. Now it's 5%. So all these operations will lead to shifting the aggregate demand curve upwards to the right, because the aggregate demand itself increased. So it leads to increasing in the real GDP, in economic growth. It's what we need here. So having low interest rates, the price of money in the economy with low return on investment, it's crucial for developed economies. And now we have another types of economic policy. It's called fiscal policy. Fiscal policy, it refers directly to the government functions. It's a direct instrument here, and the government buys directly goods and services in the market, and thus affecting the economy by increasing the total spending in the economy, and thus shifting again. It again shifts the aggregate demand curve upwards to the right. It also stimulates the economy and increases the real GDP.